Hi, everyone. Welcome to our DAT weekly market update. This is our update for January 7. This is the first edition of 2025. It's episode 321. I'm here with our co-host, Chad Kennedy. I'm Dean Croke, market analyst here. We don't have a guest today. It's just Chad and I. It's kind of a bridge week in between the 2 weeks off and when the market really gets back into gear this week. I noticed, Chad, a lot of carriers reporting for work yesterday, grumbling, complaining about the bitterly cold weather and having to get back to work. But it was really interesting to watch the transition from people holidaying and vacationing to back to work in blistering cold weather this morning.
Yeah. It's 72 down here, so I don't feel that pain. I know Ben, who's backstage with us, he's under a sheet of ice. How's the weather up there, Dean? Are you guys doing okay in Boston?
It's just freezing cold here in Boston. We've got it won't get above zero all week. Our forecast here has got some of the coldest temps so far this year. So, but Chad, we had the same thing last year. If you remember, we had the polar vortex last year.
Right.
It was a little bit later. It was 2 weeks later. I think we had the same sort of impact.
Right.
I haven't seen any impact on 3-day rates just yet. It's a little bit early to tell if we're seeing any impact across.
It did push them up last year, right?
It did, yeah. I've got some numbers on that for later in the show, but most this one seems fairly confined to the. You start in Kansas City, Missouri, all the way through to Virginia right now, where it's starting to get cold. So that's middle section of the country is certainly going to be affected. A lot of the I-70 has been shut down since Saturday, so I expect we'll see some heavy icing and road closures and much tighter capacity as those trucks slow down in those freight networks.
Well, it always goes without saying, we appreciate the truck drivers' work out there that they do. Hope they stay safe in this weather.
Yeah, it's pretty hard this time of the year. I mean, we'll see, obviously, volumes will sort of decline in certain markets, but you'll see volume go up for refrigerated trailers, right, to keep freight warm. If you think about our guest we had on, Heather Dawn, recently talking about protect from freeze and keeping warehouses warm, all those sorts of things come into play. And of course, flatbed becomes incredibly difficult in this weather when you've got frozen straps and frozen chains and tarps that crack when you bend them. So it's a tough time for everybody this part of the year. All right, let's get started. We'll come back and have a little bit of chat afterwards about what we're seeing in the contract market with Chad. I'll get started with some of the key trends that we're watching after the 2-week break. Of course, today is when the ILA port talks recommence, so that's going to be very topical in the next week. But on the rate front, rates are starting off 2025 slightly above the long-term week one average. They're only about 3 cents a mile above where they started last year. And that's after the roller coaster ride they were on between Christmas and New Year. As carriers took time off, rates surged about 8 cents a mile in dry van and 16 cents a mile in the refrigerated in that week between Christmas and New Year. Of course, Winter Storm Blair this week may change all of that. Last year, the polar vortex event sent dry van and flatbed rates up 5 to 6 cents a mile week over week, while reefer surged, increasing by about 17 cents a mile over that same period. So it was really the last 2 weeks of February where the cold event had the most impact. Last year, we expect a similar impact this year. News out last week, the ISM PMI came out last week. Moving closer to recovery was the headline. Production rebounded, new orders rising further. The ISM said that its PMI increased to 49.3. It was the highest reading since March, and up slightly from the 48.4 in November. The forward-looking new orders sub-index up to 52.5. That's the second month of expansion. So that's good news on new orders. ATA, not so good news. Bob Costello said that the frustratingly choppy freight market continued in November. Volumes were down almost 2%. And since hitting a low in January of this year, well, that would have been last year in the press release, volumes are up about 1.1%. So the good news is the trend is overall up, albeit at a slow rate, to quote Bob Costello, chief economist. Housing starts were out also over the break. November numbers fell about 2% from October. Although single family starts, the most freight intensive for dry van and flatbed carriers, provided a bright spot of news. They were up 6.4% month over month in November. The growth aligns with stable demand in the single family market, possibly buoyed by steady mortgage rates and consistent buyer interest. So that's some good news for flatbed carriers there. December imports out yesterday morning. These are preliminary numbers from our colleagues at Standard & Poor's. TEU volumes were down about 2% month over month in December, still up 13% year over year compared to that's 2023 numbers. December was the second highest December on record. Only 2020 was higher by about 5%. So we're still seeing a fairly high number of imports coming in as we predicted. In fact, as everyone predicted, not just us, but due to the inevitable tariffs that are going to come down the pipe very shortly. This week's market update that'll be out this evening, we're looking at trucking in the UK post-Brexit market. Semiconductor business in Phoenix for dry van carriers and its impact on the backhaul market is becoming less of a backhaul market as more freight is staged in that area. The latest from the Restaurant Performance Index, the RPI, a good indicator for reefer carriers, and of course a really good read. Redfin came out with their 2025 housing report. I've summarized that with a hyperlink too. It's a really good read if you're interested in what the flatbed market may hold in store as it relates to residential housing. So let's start off with our load to truck ratio in dry van. With New Year's Day falling on a Wednesday this year, last week was a 2-week shipping week effectively, making sequential and year-over-year comparisons really ineffective. New Year's Day fell on a Monday the prior 2 years, making the start of those years much bigger shipping weeks. Still, when I looked at the average daily load postings of the last 3 years for the start of the year, a lot of consistency, not much difference at the daily level. Load to truck ratio started off 2025 in dry van at 9.02. Similar story with refrigerated in terms of the sequential and year-over-year comps. Load to truck ratio in refrigerated was at, I think, about 16 it started at, and it'll probably end about that right now. And in flatbed, similar story again with the numbers. When you look at the chart, it's hard to make much sense of it because of the numbers that go up and down depending on equipment posts and load posts over short work weeks, but flatbed also around 9.02. In 16.58, I got that number wrong. Having a look at our year-over-year look at spot rates, the national average dry van line haul rate ended last week at about $1.80 a mile. That was down a penny per mile from the prior short week during the Christmas break. At $1.80, spot rates are about 3 cents a mile, or about 2% higher than last year. On our top 50 lanes, based on the volume of loads moved, carriers were paid an average of $2.20. That's 40 cents a mile higher than the 7-day national rolling average. That's one of the highest spreads we've seen between the top 50 lanes and the national average in well over a year. In the refrigerated market, capacity continued to tighten well into last week. It was up about 4 cents a mile up until last Saturday, averaging $2.22. Remember, these exclude fuel, so these are line haul only. At $2.22 a mile, reefer line haul rates have increased about 21 cents a mile in the last 4 weeks, although that's typically marks the peak in the seasonal rate movement, so we expect them to start to retreat from those high levels. Winter Storm Blair, as we mentioned at the top of the show, will certainly change that number this week, although we have to wait and see how many shippers opt for Protect from Freeze on dry freight to prevent in-transit freezing. Last year's mid-January polar vortex resulted in reefer rates jumping fairly significantly. So again, we expect much the same effect this week on that. And in flatbed, rates were down about a penny per mile last week. The national average stood at $1.98. Spot rates are starting off 2025 about 3 cents a mile lower than week one last year and about 2 cents a mile lower than 2024 yearly average. So relatively flat in the flatbed market still. Let's have a look at our short-term forecast before we bring Chad back in to talk about some of the contract rate market. Remember, these are our short-term forecast out 35 days using our flagship RateCast product. That's the green line. That's predicting what rate view will be 35 days out. It more heavily weights longer-term seasonal trends, and it's bound by upper and lower forward-looking bands in the gold and red colours. Remember, these exclude fuel, so they're line haul only, and these are for loads over 550 miles. A lot of the rates you see on our trend lines report and in other parts of the report are for loads over 250 miles. This is really just pure long haul 35-day forecasts excluding fuel. All three models, as you'll see, have spot rates in the first week of February within a few pennies of where they were this time last year. However, like last year, the polar vortex arrived mid-January, so we're going to have to wait until we get to next Monday to see what the impact of this week's storm is on these rates and the forecast. But as it stands today, prior to the storm's impact, RateCast is expecting rates to be down about 13 cents a mile out to February 6. At about $1.68, pretty much exactly where they were last year. Low case scenario has rates down 20 cents a mile. Best case scenario has rates up 6 cents a mile from where they are now. And in the refrigerated market, similar shape. Again, we don't see any surprises here. Rates are going to retreat from where they are, notwithstanding the impact of this week's winter storm. RateCast is expecting rates down 20 cents a mile to February 6th at about 203. Low case scenario down 27, high case scenario down 13. And in flatbed, RateCast has rates down about 5 cents a mile. I expect that may change this week, along with the other two equipment types. At February 6th, they expect rates to be about $1.94 per mile. Low case scenario down 10. High case scenario has rates mostly flat. So that's our forecasts for this week in the spot market. Let's switch over to Chad and have a look at what's happening in the contract market.
Yep. Thanks, Dean. I'll cover rates from a shipper's perspective, buying from either carriers or brokers. Starting out with dry van here in yellow is our spot premium ratio. This is the percentage difference between spot rates and contract rates. You can see the most recent data point here at 12/22, negative 0.6%, trending up a little bit here. So we are seeing some pressure on spot rates coming up and meeting those contract rates. This is a clear signal as this starts to cross over the 0% line into positive territory that the market has shifted, and we will see continued pressure on contract rates as carriers and brokers have other alternatives in the marketplace to get higher revenue compared to contract rates. The new rate differential, this is the percentage difference between new contract rates and those contract rates that were replaced. So it simply answers the question, what are the results of shippers' bids? We're currently at positive 1.3%. So shippers took about a 1.3% rate increase on those new rates that they implemented the week of 12/22. And you can see that's bounced above zero here for quite some time. And so we're expecting this to continue trending up. And down at the bottom there in purple, contract rate index, you can see that is sitting at 18.1%. This is relative to 2016. But you do, if you squint hard and zoom in there the last several weeks, you can see this is starting to trend up some. So we are seeing those new rate differential, those new rates start to put pressure on the contract rate index. So that contract rate index is about 80% of the freight. And then the spot freight at the very top, that's about 15%. And then somewhere around 5% of that's new rate differential coming in and putting pressure on those contract rates. So if we go to the next slide to reefer rates, that spot premium ratio, you can see quite a spike there the week of 12/22. That's the week of Christmas. I think some of the expected pressure there on spot rates and temp control are starting to show through, but a very consistent trend upwards here where spot rates are crossing over contract rates at a positive 2.3%. It's a low shipping volume week, so we'll see how this data shakes out as more data comes in and see if that comes down a little bit. New rate differential on temp control, positive 0.6. So we've seen a few weeks above 0% there and pretty flat there on the contract rate index. And then the last graph here showing dry van, temp control, and flatbed from top to bottom there. The contract rates in blue going back to 2016, and spot rates, rate per mile in yellow. This is long haul over 250 miles. What you see there on the upper right-hand corner is those spot rates for dry van starting to touch the contract rates. And you also see the contract rate starting to tilt up a little bit up and to the right. And then same thing on temp control, you see that spot premium ratio, that percentage difference, positive there. So spot rates above contract rates now. This is that signal that carriers and brokers are looking for. And then on flatbed, still pretty good separation between spot and contract rates. No significant movement there yet. So that's a wrap on contract rates.
Thanks, Chad. As we sort of start the year off, I'm wondering whether any of that surprises you, or this is pretty much in line with how you expect the market to be behaving.
Yeah, I think this is in line. We've been seeing some pretty consistent, steady trends of that new rate differential moving up and to the right, and spot rates moving up and to the right. And we expected some slow pressure on those contract rates. What we hear from our shippers is that they're starting to take a mix of slight decreases and slight increases, but on net, it's a net increase. So the majority of shippers, large RFPs, annual RFPs, they went out to market, meaning they provided the opportunity for carriers and brokers in Q4, and those will start to execute usually around March or April. So that'll be really telling to see how those rates start to as what that new rate differential does at the end of Q2. So we'll keep a close eye on that. And I think the spike in temp control, I mean, the forecast that you've been showing has been predicting that, came through. That's what we're seeing. I think this weather over the next week is going to be really interesting, even on, not just dry van, but temp control. I know you and I were just having a conversation, and shippers will start to use temp control to protect from freeze, increasing a little bit of demand as well.
Yeah. The big polar vortex event we had, I think it was 2021, really impacted Interstate 40 of all of the interstates. That's one of our busiest in the country. It's getting affected by it now. I-70, I-80 is getting touched with it now. But I suspect some of our bigger freight markets, like through the Ohio River Valley, are going to be affected by that this week. So I think it'll be hard to escape any rate volatility this week. I know the roads are definitely closed down. I-70 has been closed down through Kansas and Missouri since Sunday morning, according to the highway patrol out there. And of course, they've had pretty tough sledding out in the Sierra Nevadas on I-80 through Truckee, where I was over the vacation break. Things really slow down out that way. So again, it's a quiet time of the year, so sometimes you don't really notice it when capacity gets absorbed like this. But I think when we have severe events like this, we should see something.
Right. Yeah, we normally see that dip in rates in January, just like your forecast is showing. It'll be interesting. I know your forecast doesn't take weather events into account, so it'll be interesting to see how that plays out over the next week. Dean, I'm curious, other than like road shutdowns and those obvious types of things, what kind of stresses does this put on a driver who's driving daily, like fuel and tires and all these things they're dealing with?
If you start with the equipment, right? If you don't have the right equipment, as I saw out in Truckee on over the Christmas break, a lot of guys don't have chains, and they run into the chain control at the bottom of Donna Pass, and they get turned around and have to go and park up, or go and buy chains. And then, of course, they're out there in the wrong clothes. So clothing becomes a big issue because a lot of guys get caught in these snowstorms if they're irregular route, one-way network type drivers. They could be in a warm climate one day and in freezing cold blizzard conditions the next, if they're traveling south to north in the US in particular. So a lot of people get unprepared. The other thing, so equipment's a big part of it, particularly with flatbed, just in terms of the physical aspects of working in the cold. A lot of people are really unprepared for it. But I think where it hurts the most is drivers are paid primarily by the mile. So not only do your accessorials drop because you've got fewer stops, you've got less miles overall. So the miles not only become harder because they're harder to drive in, there's fewer of them. And that's the real impact is Capacity takes a real hit. It's not that the number of trucks suddenly diminish. It's just that the network grinds to a halt and you've got far fewer trucks moving. Very similar effect than what we saw in the pandemic when we couldn't get off warehouses because of lack of staff on loading docks. It wasn't that we had more loads. It's just that the trucks we had were running at a much slower average speed through the entire network. Yeah. And that's pretty much what we'll see happen this week. Very similar effect to hurricanes. Not dissimilar in that regard, where you see the network slow down. Power outages, I think, Chad, are probably the bigger thing on the demand side, because all of the workers that work in plants and factories that produce freight either can't get to work, or the factories they work in are without power. Right. So there's a whole supply chain impact here, both from the home all the way to the road to where loads get built and made, and the trucks that pick them up. It's quite a big deal when you work through that.
Right. Yeah, I would think that one of the things you touched on there is that average speed reducing. So even if there aren't road closures, but just bringing it down from 55 to 35 or 25 has a big impact, right?
Well, that's optimistic. I was watching some live camera feeds yesterday on I-70 through the Missouri DAT, and I was really shocked. A, trucks are out there, B, hammering, and C, way too close. Wow. Yeah. And I've driven into pretty nasty conditions, but my survival skills kick in. Either you shouldn't be out there. It was really interesting. I had a discussion with a California Highway Patrolman last week, and we talked about chain control. And he said, if you need chains to drive, you shouldn't be on the road. And it was a really interesting thought. And of course, what happens here is a lot of people think it's just something you need to keep yourself moving, as opposed to stopping. Because from a driver's perspective, no load is worth your life or anyone else's life. You really
That's exactly right.
But because drivers are paid by the mile, they've got all these pressures. I understand it. I've done it. So they try to keep moving the best they can. And I think the thing with weather, though, sort of to wrap this thought up, is most drivers are taught how to drive in weather, but that's weather you can see, right? So whether you can see and feel, but where you run into trouble is with ice, because you can't see it, and whiteouts, because most drivers are not connected to their outside environments through CB radios or any form of communication. So whiteouts and ice, which are the factors that are happening this week, are two of the things that really cause the most devastation. So I hope it doesn't happen, but I'm kind of waiting for the inevitable news story where there's been, a dozen, maybe 100 vehicles piled up in a whiteout because everybody plowed into the back of each other. It's really quite a scary prospect.
Well, let's hope not. I'm curious, the time it takes to put on these chains. How long does that take, Dean?
It's about 20 to 30 minutes. I sat and watched a bunch of guys do it on the chain up pad in Truckee last week. It's about 20 to 30 minutes if you do it properly. For some drivers, though, they don't hang their chains under their trailers, so they're ready to go. They have them piled up in a mess under the sleeper cab, and they all get tangled together. So that's where the time gets lost. It was interesting to watch. A lot of guys just whip by the chain control at the bottom. So unless chain control is stopped to one lane and Caltrans are physically inspecting every single truck and car, sometimes they let you go through, and you take a chance. If the weather clears as you're going up Donna Summit, you might not have to pull over halfway up to put your chains on. There's a couple of ways people attack this. But if you get caught halfway up, it takes much longer because there's much less space to do it. It's really quite a fascinating thing. I know we write about it every year. We say to people, get prepared for winter, make sure you've got plenty of food, extra clothing, gloves, all sorts of treatment for your fuel, make sure your airlines don't have any liquids in them, all those things. Clearly, there's a lot of people not listening to our show or reading what we write, and they get themselves into trouble. It was even funny to watch the California Highway Patrol yelling at people over their police vehicle PA systems, and they've actually got a very funny social media channel where they make fun of a lot of the utter stupidity that goes out on the roads. It's actually quite entertaining to watch the CAP guys up on top of Donna Pass. That was sort of a highlight of my week out there.
Well, let's hope a lot of them are tuning in and heeding your advice, and everybody stays safe, and we don't hear about those pileups. Yeah,
unfortunately, Chad, experience comes from a lot of poor judgment, and in trucking, a lot of drivers make a lot of bad bad decisions, and that's why you get experienced. I'm not saying I'm perfect. I've made a lot of mistakes in my time, but I've learnt from them. That's the difference. So,
Yeah. Right.
Switching gears, I read a really interesting report over the break from Bascom Majors at Susquehanna Investment Group, and he was talking about 2026 being a recovery year and this year being what he called a bridge year. I was really fascinated by that. And one of the thoughts he had was that with capacity exiting at such a relatively slow pace, excess supply continues to weigh on gradual recovering in demand.
Mm-hmm.
And it really struck me because we're sort of thinking about some sort of recovery in the freight market mid-year. I wonder about how much capacity is going to stay in this market.
Right.
We have seen capacity exits accelerate in December, which was a little bit against trend. Normally, carriers stay in the market right through till 12/31. I just sent a note off to some of my insurance colleagues this morning to see if 12/31 renewals saw any surge in non-renewals.
Right.
Common renewal date for a lot of carriers or small carriers. So I'm interested to see if that happens. But I just wonder if that's going to weigh on the market all year. That's a trend because we also read over the weekend, FreightWaves had a good article out last week about tender lead times extending, and you and I had some dialogue about that. I wonder, are shippers bracing themselves for these fluctuations in capacity by extending lead times to sort of to insulate themselves from any capacity shocks?
Yeah, I've not heard much about that from shippers extending lead times. Most of them have this programmed into their ERP and TMS to settle. I know when I was at CHEP, the pallet company, we generally had a 48-hour lead time, and then anything shorter than that could fall into the emergency load category that we felt like we had to scramble for. But and then extending them, the feedback we would get from brokers and carriers was once there's kind of diminishing returns. Once you start to extend that out too far, there's no benefit and actually might hurt you. So there's probably a sweet spot there somewhere around 48 hours or 72 hours to keep that within.
Yeah. You touched on pallets. Great article in the Wall Street Journal about forklifts. And of course, forklifts are deadly. I'm probably the worst forklift driver on the planet. I cannot drive a forklift to save myself, because as a truck driver, you invariably have to get on a forklift and load and unload yourself at some point. The article was talking about not really the death of the forklift, but the demise of the forklift or lift truck.
Mm-hmm.
And they were talking about sales in forklifts or lift trucks had dropped 28% last year. And it got me thinking about pallets. And I wondered about this shift towards more automated robotic type packing devices, and whether that had an impact on the standard 48-inch pallet that we're so used to.
Yeah, we should get our friends at the pallet companies on here and have a conversation about it. It'd be interesting. I have a hard time envisioning how else you're going to get a large amount of freight quickly on and off a truck.
Right.
I know some of these articles were featuring automotive, or this article I think you're referring to is featuring some automotive and large appliance, Whirlpool, and I think Tesla, and how they're using conveyor belts. But if you've got that large of a piece of equipment, I can envision loading a truck with that without pallets, possibly. But things like tissue papers and toilet paper and other fast moving consumables that are smaller and packaged, I think you're going to have to rely on the pallet.
What also got me thinking about it, yesterday I was in Grand Central Station. We were catching the train home from New York City, and I saw this box truck parked off to the side, and three guys were unloading it and stacking it on the hand carts. And there was a security guard standing there. And I thought, this is really strange for like 1 p.m. on a Saturday in the blistering cold. And then as we walked a little bit further back to our hotel, there's a guy pushing this trolley with all of these Amazon boxes on it. And it occurred to me that this truck parked on the street was the staging area for all of their Sunday deliveries in downtown Manhattan.
Wow.
This is on a Sunday, right? And this trolley had maybe 25 boxes on it, and they were making deliveries. But the fact that there was a truck that was preloaded and staged with, floor load boxes got me thinking about this whole change in how we move freight and how things get delivered. And the fact that freight, Zach Strickland had a great chart of the week this week where he was talking about tender volumes decreasing in the middle mile, but increasing in the city mile area. So what he implied was that there was a lot more freight moving shorter distances, and part of me got to think, well, maybe that's just because we're on the tail end of retail season and the start of return season. But I think it's more of a feature now of how freight gets moved. Is we're moving a lot more freight shorter distances. The consignments appear to be smaller in volume, and maybe that's where we start to see the impact of pallets or lack thereof.
Yeah, I think is we might be phasing more into just in time instead of just in case as we come out of the COVID era. Maybe that's going to make packaging a little bit smaller. That could have an effect. But we should look at our data too and see what length of haul in our data set's doing. See if it's changing much. It has an impact on rate per mile too, as we report those metrics out. So something we should keep an eye on.
Yeah. All right. Great talking to you, Chad. Couple of shout outs. Chris Kaplis is talking to Andrew Petrisen. He's Deputy Assistant Secretary. I hope I've got that name right. He works at the US Department of Transportation. He's the creator of the US DOT's Freight Logistics Optimization Works or Flow. That's a private partnership where they're looking at certain aspects of the supply chain. Don't miss that. I'll be on Radio Nemo with Jimmy Mack this Thursday, 8 a.m., channel 146 Road Dog Radio. Make sure you set up alerts for the show and subscribe to our channel at DAT Freight and Analytics on YouTube. So with that, our first show of the year is in the books. Thanks for watching. Be safe. Be nice to everyone. We'll see you back here next week at 10 a.m. Eastern, 7 a.m. Pacific.